You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Ladies and gentlemen, today's guest is Kavitha Baratakke, a principal at Cherry Street Investments, an Austin-based real estate investor, and a full-time multifamily sponsor with over 10 years of investing experience in single-family and multifamily real estate. Prior to real estate, she spent 19 plus years as a technology professional working for IBM in various roles across software development, customer service, partner relations, and technical account management. Kavitha has successfully acquired, rehabbed, managed, owned, and operated several single-family and multifamily investment properties in Central Texas area. She is currently invested in over 2,000 units or doors, however you want to say it, in San Antonio, Dallas-Fort Worth area, Atlanta, Phoenix, MSAs. As a limited partner, she's also an owner of, as a limited partner and as a general partner, KP, she has 450 doors under management. So Kavitha is doing some amazing things. She's crushing it right now. So that's why I wanted to get her on. How are you doing today?
I'm doing great. Thanks for having me on.
Absolutely. I'm glad you came on. I'm sure you're going to add a lot of value to my listeners today.
I hope so.
So tell us a little bit more about you. I mean, that was a pretty short bio. Tell us a little bit more about how you got into real estate.
Sure. I started in about, I think 2009 was the first time I thought about real estate because I started investing a while ago. I've always been like an investor type. I always wanted to play with money. It was something I really enjoyed doing.
Yeah.
So I was trading options for a while. Someone at work got me into that and really enjoyed it, but it was like that high and low, I made money one day, I lost money the next. It was just all over the place. And I think that was necessary, but I didn't enjoy it at the time. It seems like, you were riding a high or, sinking into a low, depending on how the market went. So I didn't, I got tired of it pretty quickly, but it did teach me a lot about money and my relationship with money, I think. So I think it was a very valuable experience looking in hindsight, but I also got really tired of it. And I figured while the going was good and I was positive, because it's very easy to be negative when you're trading options. So while I was positive, I figured I'll pull some money aside and invest in real estate. And when I looked at the market, it was trashed, right? Like there were houses in Austin selling for $98,000, which put it at about, most of the houses were like $53 a square foot. I mean, that's not even construction cost, right? That's not even replacement cost. So I figured, hey, following Buffett's rule, right? When everybody gets out of the market, that's when you get in.
That's right.
So I said, hey, why don't I try buying a house and landlording and see how it goes. I wasn't keen. Like the realtor I was working with was very experienced. So he had a lot of investment homes himself. And he was like, just buy up the whole block. I'm like, no, I don't think so, because I don't know how this is going to go. I might hate being a landlord. I don't know how it's going to pan out. So let me take it like one property at a time. I first want to figure out what the experience looks like, and then I'll decide to go ahead. I never considered getting straight into commercial. Like most investors, we start with single family, right?
Yeah.
So that happened, and my tenant happened to be like an amazing person, and I had a great experience. I mean, of course I got calls and things went wrong, but it didn't happen as often as I anticipated, or I didn't know what to expect. So it went pretty well, I thought. So after the first year, I bought another house. And so ended up buying almost like a house every year. One, of course, I needed to save up, and two, I was a single mom and I had a job, but obviously I wasn't able to build as much capital, because as an investor, you're putting 20-25% down. It's not like you're getting in at 3%, right? So it was like a slow process, but then as the equity started to build up, I started to tap into the equity of the homes and then buy more. So it worked out really well. I had a house in India that I sold, and then I bought a house. I bought a couple of houses because in India it was all cash.
Yeah.
So it was easy for me to, it wasn't easy for me to bring it here, but it was easy to get all the cash out and actually create like multiple homes here.
Yeah.
So that's kind of how I got started. And I thought I'm going to retire doing single family homes, but sadly in Texas, the property tax rates are between 2.5 and 3.5.
Wow.
And that's really hard to make money as the appraisals start going up. And the
Yeah.
county is really on par with the market value.
Yeah.
As far as the appraisals, the assessed values go,
Right.
they're almost the same as the market values. So it's really hard to make money in Texas on single family homes anymore. So
Yeah.
I started I went to San Antonio to shake things up and see how that market was, and learned a lot about, invested there, and then decided none of this is going to work. I needed to go back to the drawing board and learn about multifamily, like scale and economies of scale.
Yeah.
So just about the same time, I happened to get in touch with a friend of mine, actually just randomly got in my way, friend's friend, who was investing in apartments, and she was a part of the Samrock group. So
Yeah.
ended up going there, and yeah, that's kind of one thing led to another, and I'm here. So
Right.
it
Right.
worked out. It worked out well.
That
So
sounds like it. So you got your start in the residential side, and it was going well, but then taxes started going up, so it didn't look as good anymore. So you was kind of looking for different options, different opportunities,
yeah.
and that's how you stumbled across the Samrock group. Now, explain that group to some people that's not understanding who that is or what they do there.
Sure. There are a lot of these mentoring groups. What they do is help you kind of guide you or mentor you in terms of education on the investment. Because I always tell investors, if you want to just passively invest, you probably don't need to learn a whole lot about the business. But if you're intending to actually become an active investor, go out there and buy an apartment or a hotel or whatever investment it is, it's
Yeah.
not the same as buying a single family. You really want to learn about the business, because there are a lot of nuances, and you don't want to make an expensive multi-million-dollar mistake.
Yeah.
So it's worth spending to learn from people in the business. So
Yeah.
I think that's very important. And all these mentoring groups essentially exist to provide you not just the foundation for education, but also the team that you need to create to go
Right.
buy those deals, right? Like
Yeah.
nobody's going to give you $1 million loan or a $2 million loan if you haven't done that before, because they want to
Yeah.
see a track record, and you can't build a track record unless you start somewhere. And these
Right.
groups kind of charge so much money because they give you that start,
Yeah.
and they connect you with people that have that experience and can help you build that experience. So
Yeah.
I think we all, I'm not endorsing one group or another.
Right.
There are a lot of groups out there. You can look for yourself. But
Yeah.
I think it's important that if you're going to be on the active side of the business, that you get educated on it.
Yeah. I will second that for sure. I jumped into Vinny Chopra's
Yeah.
academy, and he got some good stuff going on there as well. So
Yeah. I met with him actually.
oh yeah.
I was in Danville,
Uh-huh.
and he's amazing.
Yeah.
I had a great time getting to know him.
Yeah. Vinny's a good dude. All right. So, you've been in it for a while now, and there's a lot of different asset classes out there. I mean, you could do hotels, retail, self-storage. Why are you sticking with multifamily?
I'm actually looking at other asset classes right now. I'm looking at
Okay.
hotels. I like multifamily though as a primary mainstay for me in terms of an asset class, because multifamily does really well through recessions if you buy it well, of course, if you
Yeah.
pay the right price, and um, because people need a place to live, right?
Yeah.
So that's a very important factor with multifamily, because doesn't matter what the economy is doing, people need a roof over their heads, whereas some of these other asset classes are prone to more fluctuations.
Yeah.
But that said, right now, I think multifamily is also very hot. Anybody who
Yeah.
wants a piece of the pie.
Right.
So I worry that we are overpaying at some point. So that's kind of why I'm starting to look at a couple of other asset classes like mobile home parks and hotels this year.
Yeah.
So just to expand the range of options, and also because cash flow is very good in these other asset classes.
Yeah.
And I think as we get into a possible recession in the next few years, the cash flow is important, right?
Right.
Cash is king. It tides you
Absolutely.
over a bad market. So
Absolutely.
I do think there's value in looking at other asset classes. I'm not married to multifamily, but it's what I
Yeah.
know, and I think I know really well. So it's
Yeah.
my strength.
Yeah. And now hotels, that's something that I'm starting to hear a lot of people starting to talk about. But I'm not too familiar with it. So tell me, what is it that you typically look for when you're looking at a hotel? Like as far as what's a good opportunity? How do you add value to those? Like, could you elaborate on that?
Sure. I'm not a hotel expert, but I am working with some hotel experts. I'm working with some hotels who have been in the business like multi-generationally. That's
Oh
all
wow.
they've done. They live
Yeah.
and breathe that stuff. It's so cool.
Yeah. Yeah.
But it's sort of similar to multifamily, but different in the sense of there's branding and like franchising involved in hotels, right? So you can rebrand and make it
Yeah.
a better brand,
Yeah.
and then do all the PIP, it's called a PIP, like basically all the requirements that that brand wants you to do. You
Yeah.
implement those requirements as far as how the rooms should be decorated, what the furniture is, how it should look, the colors. So
Yeah.
every brand wants that uniformity in look, right? So you implement all those plans, and whatever it costs you to implement is your rehab budget, basically.
Yeah.
Obviously, the numbers per key is higher because you're looking at a furnished unit versus
Right.
unfurnished in multifamily. But the
Right.
concept is essentially the same. You're working on the NOI, you're working on increasing the revenue of the property.
Mm-hmm.
Because in hotels, the valuation is a multiple of the revenue versus NOI. They
Yeah.
don't take the NOI into account, they take the revenue into account.
Wow.
So, the net revenue.
Yeah. Yeah. Yeah.
So, yeah.
That's pretty cool. Now when you're talking about these big brands, you're talking about like Hilton Honors or Hampton Inn. Do they kind of like take like a franchise fee or something? Is that kind of how it
Absolutely.
works?
Absolutely. It's a percentage of the business.
Mm-hmm.
So let's say we are doing a hotel right now that I'm actually going tomorrow to look at it.
Mm-hmm.
So it used to be a Holiday Inn, then it
Yeah.
got kind of down branded to independent franchise right now. And
Yeah.
so we're going to rebrand it at a higher brand. So with the
Yeah.
Choice Hotels. So essentially we'll renovate, and we will bring that property up, and
Yeah.
then we are able to charge more higher room rates per day,
Right.
the we call average daily rate or ADRs. And
Yeah.
then we're also able to add value because again, I think location is any property, right? Location is really key.
Yeah.
And in hotels, I'm looking at uh, locations which see traffic that will less likely be affected by recession. For
Yeah.
example, let's say a medical center.
Mm-hmm.
People get sick. It doesn't matter whether the economy is good or bad, people
Yeah.
get sick. So
That's right.
that kind of occupancy, like a hotel in that medical center or a hotel along I-40, where transient traffic is going to be there
Yeah.
because it's life as usual. People have to drive, people have to go to places. So
That's right.
those kind of locations which are less prone to, I mean, everything's going to hurt during recession. Apartments are as well.
Yeah.
But how can we minimize that hurt, and how can we minimize the downside? I think that's kind of the goal.
Yeah.
And in hotels also, the cash flow is so much better than apartments,
Yeah.
that it gives us a little bit more playroom, because the cap rates are like, we're looking between 8 and 10 caps for hotels, and right now in apartments we're looking like maybe 6,
Yeah.
depending on the market, 6 to 7.
Yeah.
So,
Yeah.
we're just playing with the numbers here.
Cool, cool. That's very interesting. I'm going to look into it some more because I'm always looking for different ways to diversify what I'm doing. So I'm definitely
Yeah,
something to look into for sure.
yeah.
Okay, so let's talk about when you was first getting started. You did a single family,
Mhm.
and you transitioned to the multifamily. Let's talk about, because there's a lot of people that's going to take that same progression. Some people thinking about it now. What was the biggest challenge you faced during that time when you decided, hey, I want to do multifamily? What was next?
So I think when I started, it was just like I'm going to do passive initially. That was clear because I was in IT. I had a full-time job. I had a kid. I didn't have much time to really
Yeah.
jump into it actively when I
Mm-hmm.
started. So I just said I'm going to learn. The objective is just to learn as much and gather as much information as I can.
Yeah.
Network with a lot of people, build those relationships
Yeah.
and invest passively, learn the business. I would go on apartment tours, learn,
Mm-hmm.
and then I think I got to a point where I'm like, I feel fairly confident in what I know. And I think I'm ready to switch over to the other side.
Yeah.
But I also wanted to just buy my own apartment. I didn't want to take other people's money.
Yeah.
And I kept looking all of 2018. I kept underwriting, but didn't find a deal that I was really happy and jumping into. And I also had refinanced my homes and I had some capital set aside.
Yeah.
So anyway, to cut the long story short, I went through that process and decided it's better for me. After I met someone at one of the events, he convinced me and talked me out of buying my own small deal, and
Mm-hmm.
instead convinced me to join forces and go bigger with him.
Yeah.
So it just so happened that I think a lot of this business is about relationships and networking. So as long as you're connected with the right people
Yeah.
who can guide you and who can, I mean, and I think it's very important also to figure out what is that you can add value with,
Yeah.
because you can't do it all. You can't be a sponsor the first time around, doing acquisitions, doing this, doing everything that an apartment building or acquiring multifamily takes.
Yeah.
So I think it's very important for us to figure out, the easier way is to figure out what part of the business you're really good at. So let's say I have a person I met recently. He's really good at marketing
Yeah.
because he's done single family marketing. He's wholesaled a bunch of homes. He's
Yeah.
flipped a bunch of homes. So for me, his strength is acquisitions and reaching out, maybe getting off market deals,
Yeah.
maybe doing the rehab, like the actual boots on the ground
Yeah.
asset management piece, because that's his strength, leveraging from what he's already learned in single family.
Right.
For me, it happened to be capital because I was connected to a lot of people who had money. And
Yeah.
to me, it was a natural progression. I come from IT. I'm connected to a lot of engineers, a lot of doctors, because
Yeah.
I'm connected. I have family who are doctors. So
Right.
it just expanded that way. It just worked out like that. Like when I thought about it, I was like, okay, this makes sense because someone else saw in me I couldn't see in myself. So I'm grateful for that. And he said, hey, you should consider doing this. And I tried it out and it seemed like a natural fit for me. I love educating people.
Yeah.
People seem to want to invest with me. I didn't have to try very hard. I don't
Yeah.
I don't mean to make that sound cocky, but it's it's sort of, see, I think I had also been talking about real estate investments for a very long time. So it
Right.
just people naturally associated me with real estate, and it was easy for
Yeah.
me to break that door open.
Right.
But start with leverage your strength. I think that's the bottom line. Leverage your strength, figure out what you're good at, find other people who are good at something that you're not. Like acquisitions was not my strong point. I tried
Yeah.
for a year
Right.
to contact brokers and to get a property, and didn't work.
Yeah.
So I'm like, okay, why don't I work on a deal that's already existing and someone else is
Yeah.
trying to acquire it,
Yeah.
and see what I can contribute to that
Yeah.
deal. So
Yeah. Yeah.
yeah.
So generational wealth listeners, I want you to really, take that point down. It's about building a team. You can't do this by yourself. And, if you're just getting started, you're definitely going to need a team. So the point that she made was find out what your superpower is. What are you really, really good at? Nobody can beat you at it. And you take that to them and say, hey, I can bring this to the table. I can add value for you here. And if you can do that, you can find your way into a deal, because believe me, everybody needs help, and everybody needs a team to get it done. This multifamily game is just like when I play the NFL. You got to do it with a team. You can't go out here and think you're gonna make all the plays by yourself. Believe me, you need an offensive lineman blocker for you. You need a running back. You need a quarterback. You need all of that to make it happen for you. So I appreciate you sharing that with us, man. It really does take finding what you're good at and adding value to other people to make it work for you.
Right.
Okay,
Teamwork makes the dream work, right?
absolutely, absolutely. So, what markets are you focusing on right now as far as multifamily goes?
Um, as far as multifamily, I'm working in Texas. I like Phoenix too, although it is getting very hot. I'm looking at Florida, and I'm open to, I'm talking to a few people in Atlanta and the Carolinas
Yeah,
because uh, to me, those are all great markets to invest in. But
yeah,
of course, they've all seen a huge upside already.
right.
So the question is to buy it right.
That's
So,
right. That's
yeah.
right. That's the biggest key. You gotta buy something that has some meat left on the bone, so to speak.
Yes, and we know that's getting more and more challenging as the time goes along. So I'm
Absolutely.
hoping there'll be like a little correction somewhere along the way and we'll have
Yeah,
a little buying opportunity, but
that's right.
maybe not this year. I think we'll still be pretty high this year. That's what
Yeah,
it sounds like.
yeah. Gotcha. All right. So when you're looking at deals, what is the ideal unit account for you as far as when you're going out market?
I'd say I don't really have a unit count. It's the deal that works. Uh, we don't generally look at units like deals below a certain number of units just because the economies of scale. I think the smallest deal I've done was Phoenix with 76 units, but
Mm-hmm.
of course the price per door was also 100K, so
Yeah.
about 7 million or so.
Right.
So I think we generally look at 50 plus doors
Yeah.
across all markets. So
Okay.
yeah, yeah.
Yeah, that's interesting. I mean, a lot of the syndicators I talk to, they won't, look at a deal that's below 100. So that's interesting that So what is your strategy around that? If you find, like, let's say I bring you an opportunity, because I'm a broker here in North Carolina. Let's say I brought you an opportunity in Raleigh, and it was 55 units. How do you guys make that work? Do you kind of find a killer property manager that can do it off site for you? Like, what is your strategy around that?
So I'd say combine, like I'm looking at a deal right now in San Antonio. It might not be the biggest deal. We have a bunch of like a 16 unit and a 35 unit and a 32 unit, but combine, like
Mm-hmm.
if you can't find a big enough deal, then see
Yeah,
if you can combine multiple smaller deals to make a bigger deal.
yeah,
So that way the numbers work in terms of, by the blended cap rate works,
yeah,
and also the property management and all that becomes easier if you can have the properties. Of course they have to be in physical proximity to each other,
yeah,
but that
yeah.
works out as well, because
Gotcha.
like you said, a lot of syndicators are looking at 100 plus, so we
Yeah,
tend to be hot in that 100 plus range as well. I think at
yeah.
least 70 plus, I'd say.
Right.
So sometimes it might not be a bad strategy to go find a smaller unit size
Yeah,
complex and then maybe combine and buy something else close by which is
yeah.
also smaller. So I'm open to that strategy as well.
Oh yeah, that's actually a really good point, good tip there. You can find a couple smaller, like 30, 30, 30. That you got 90 units there. So,
Yeah, I mean, as
yeah,
long as they're close enough that your manager can hop from one to another.
yeah.
Or I've heard this from another broker, and I never thought about it, but I think it's a great tip, is if you can talk to a property management company. Let's say you have a 35 unit and across
Mm-hmm.
the street there's like a 300 unit complex. If
Yeah.
you can talk to the property management company there to manage your 35 unit, I
Uh,
mean, think about it
yeah,
from a logistics standpoint. It's not
yeah.
that difficult for them. They're right across the street from your
That's right.
property,
That's right.
and they might be even willing to do it at much lower than the usual 7 or 8% that you would pay on a smaller property,
Yeah, yeah.
just because of, hey, they're already across the street. So
Right.
there's opportunity you can create in so many different ways.
Man, that's a good tip. I never heard of that one. So that's really
Yeah,
good. Thanks for sharing that tip there.
yeah.
Okay, so let's talk about when you're underwriting a deal. What are some of the red flags you look for, like to say, hey, this doesn't look right. This is not a good buy for me.
Yeah. So, when I first started, I think I was a little misguided because I looked at the price and paid
Yeah,
too much attention to it. And I've
yeah,
gotten away from that now. Um, So definitely location is super important for me, like what's going on in that submarket in that particular area as far as job growth and all the retail and, what are the sources of the tenants.
Yeah.
But in terms of underwriting, I'd say a couple of things. Of course, the rent growth is a big one right now because as we head into a possible recession, I'm thinking, okay, what is rent growth going to look like? Maybe it's going to be flat.
Yeah.
Maybe it's going to be 2% growth and 2% growth in expenses, which means it's basically flat, right?
Right.
So you're really not going to see a whole lot of rent growth. But maybe you'll just see the first year bump, hopefully not too aggressive because we are doing rehabs and we
Yeah.
will command a higher price for those rehabs. But as we go along, we might have to start getting more and more conservative about those as well. So I think definitely the rent growth estimates for the first year after rehab and also subsequent years. I don't want to
Mm-hmm.
see anything too aggressive.
Yeah.
And the economic vacancy as well, which is, for the listeners, economic vacancy is not just a physical vacancy, but also bad debt and
Yeah.
loss to lease, which means your rents are not at market rents for all the units. So you have a little bit of loss in the number in the dollar amounts there.
Yeah.
So all of those, I'm looking for a conservative number for the economic vacancy, depending on the market. So
Right.
you cannot underwrite Dallas at the same economic vacancy as, let's say, San Antonio, because typically we are seeing San Antonio have much higher vacancy rates, economic and physical,
Yeah.
than Dallas. So the location also, of course, if you're in a Class C location, you're going to see higher bad debt than if you are in a Class B location where
Yeah.
bad debt is really not an issue. So all those factors really important. And the exit cap rates, last but not least, everybody talks about that.
Yeah.
So you want to underwrite at a higher exit cap rate than you're buying because you're assuming that the markets gets worse, not better with
Now
time.
let me ask you a question around the exit cap rate there. How do you gauge how much you should put into the cap rate? So let's say you're buying at a 5 cap today. Is it just a rule of thumb for you to, all right, I'm going to put it at a 6 cap when we exit, just 1 point higher? Or what is your rule there?
The rule depends on the property and the class of the property. I think it's very important, and the location.
Mm-hmm.
So for me, I did come from a point of view of being in the Samra group. It was just a flat 100 basis points higher, 125 basis points higher.
Yeah.
But I think there's got to be a little bit more clarification or change around that, because for these nicer properties, you
Yeah.
don't need to underwrite at 100 basis points higher, because these properties don't see that much change in exit caps or cap rates when they sell, because they're
Yeah.
nice properties and they
Right.
have a solid tenant base and they are in great locations. So I feel like we should adjust that number a little bit. But
Yeah.
general rule of thumb, I'd say 20 basis points for every year of hold is what I've seen people talk across the board, which means if you're doing a 5-year hold, you're talking about 100 basis points,
Yep.
which would be super conservative. But I'd say the minimum I've seen in deals would probably be 50 basis points higher.
Yeah.
But
Gotcha.
what would make me comfortable is between 75 and 100.
Yeah. Yeah. Good deal. Good deal. Okay. So there's a lot of people that's getting into the syndication space. Like you said, everybody wants to be in multifamily right now. So what's the biggest rookie mistake you see people making?
I think location, overpaying for locations, because so let's say I am paying 90 a door to get into a Class C location. Now, I'm thinking if the economy and the cash flow is really tight, and it's not the dollar amount. Like let's say I'm paying a 4.5, 5 cap in a Class C location. The
Mm-hmm.
problem I see there is these Class C locations and the tenant base, when they are below a certain dollar amount in terms of household income. Let's say the property I saw was like, I think 30 something $1,000 in household income, which is
Yeah.
very low. And you're paying 90 a door. To me, something's not right there.
Yeah.
So I'm thinking you're going to see a lot of bad debt in a downtown with that kind of tenant base.
Yeah.
So it's just don't go by, I mean, don't go into a deal because either the dollar per door seems reasonable or whatever compared to the others. 90 a door is nowadays reasonable, as
Yeah.
unreasonable as that sounds.
Yeah.
But for that location, I don't think that's reasonable. Like I bought into a property which was 142 a door, which sounds ridiculously high,
Yeah.
but the median income there was 123K. So we're talking about a completely different tenant profile there. So
Right.
it's
Right.
the dollar per door is not as important as what's your rent per door, what's your tenant base, what kind of bad debt will you have to deal with. So all those factors are important.
Yeah.
The other thing I'm seeing is a lot of people, I think a rookie mistake, I think I made it as well, is to just be fixated on cap rates.
Yeah.
Because I mean, doing an 8 cap deal doesn't make any sense if you're going into a market that has no growth, right?
Yeah.
It's just cash flow. That's it. You're not going to see an equity upturn.
Yeah.
That's the whole idea of this game, is that you not only have cash flow, but you also build equity over time.
Right.
And that's really where our big bump comes from. So just be careful of what you're getting yourself into. Just don't be completely into cap rates, because I mean, people talk about 10 cap. I'm like, that's a location I probably don't want to be in. I don't
Yeah.
know. Yeah,
Yeah.
or the market that I don't want to be in. So for
Right.
me, the job growth and all those drivers are more important. Of course, the cap rate matters because I want to have cash flow for the property, but
Yeah.
that's not the number I'm looking at.
Right. Right. That's good points. Good points there. Okay, so let's segue into the next segment of the show. We're going to do a deal deep dive. So
Okay.
let's talk about a deal you've recently done or that you can remember. Unit count, debt that was on it, and what was the value add on it.
Sure. I'll talk about the one we did in Phoenix. We did. I'm trying to remember the numbers. It's a 76 unit, and our raise was we did about 98 a door.
Mm-hmm.
Let's call it an even 100 a door. So that's 7.6 million.
Yeah.
And then we, of course, had a rehab budget and all that. I'm not going to be exact on the numbers,
Yeah.
but usually for most multifamily, we raise about 30% of the capital, right?
Mm-hmm.
Like if we have a $7 million deal, we're raising 30%. If we have a $10 million deal, we're raising about 3 million.
Yeah.
And the rehab budget, because
Okay.
sometimes the rehab budget is not financed and sometimes it is.
Yeah.
So in this case, it wasn't. So we did raise a little bit more than 3 million for the deal.
Yeah.
And the idea was to get in there and rehab the units completely, and do a pretty good high-end rehab because the location was good. It's
Yeah.
in sort of the path of progress. It's called Arcadia in Phoenix.
Mm-hmm.
And we are seeing a lot of gentrification happen in that area. And we are right across a Class A building, a
Okay.
Class A apartment. So we
Yeah.
knew that we could potentially get those tenants if we could offer a better price point for the
Right.
rehab units. So
Right.
we know that the market there is good enough for us to put in granite countertops, washer dryers inside the apartment, and all
Yeah.
the good stuff.
Yeah.
So the good thing about that property is we bought it in August, and right now it's been 100% full, and it's been hard to do a rehab because we don't
Yeah.
have units vacant.
Right.
That's a
Right.
good part of it.
Yeah. Yeah.
And we've also been able to push up the rents without rehab for units because
Wow.
the market's just on fire.
Yeah.
Like we don't. I mean, we are not gonna. I don't think we should claim any um, credit for it because
Yeah.
it's the market that's doing it, right?
Yeah.
But finally, I think we have about 3 to 5 units vacant now. As December rolled around,
Yeah.
and we are going to start doing the rehabs on those. And in Phoenix market, the labor costs are a little higher than Texas. And
Yeah.
we used to like $5,000 rehab.
Yeah.
There we actually budgeted much higher rehab costs, like
Right.
closer to 10 to 13, I think per door was the rehab for that one.
Yeah.
I don't think we'll really get to the point of spending all that money that we've taken in capital. So it's a good thing for our investors. We're going to have money. And we actually did the first distribution on that property in 3 months.
Wow.
Yeah. So it's just a deal, right? Like it was a killer deal. We got in at the right time. A property down the street from us just sold, very comparable,
Yeah.
just sold for 30K a door more than what we paid. So it
Wow.
sold for 130K a door, and we bought it at less than 100K a door. So
Yeah.
I think our investors will hopefully have a killer deal in the making.
Yeah. Yeah. Absolutely.
So our
So.
strategy on that was also a short-term hold, like 18-month hold.
Mm-hmm.
So we wanted to just renovate and sell. So we'll see how much renovation is going to be more challenging because we're not getting units vacant as much as we'd like them, as quick as we like them. So
Yeah.
we'll just start testing the market. We'll start doing the rehab and then putting it out there and seeing how much rent bump we can get on those units, the
Yeah.
rehab units. So
Gotcha.
yeah.
So, what was the debt you put on it?
We did, I'm trying to remember because this has been so many deals. We did a deal
Yeah.
after that, so it's all like blending into one. Usual 10-year, I think we got in around a 4%,
Mm-hmm.
something. Was it 4.25, I believe?
So this was
10-year.
Fannie Freddie.
Yeah, yeah. It was an agency loan. There is a prepayment penalty, which is why we probably, if we are going to sell it, we look for an assumption,
Yeah.
most likely. So, yeah.
So
What
let
else?
me ask you this question here. I mean, if you guys went into it knowing you was gonna, try to sell it within 24 months, why not go with something like a
Bridge.
bridge loan instead?
I know. I knew you would ask me that. I think we weren't sure if the market's going to be conducive to selling. So it's one thing when you know you want to sell and whether the market's going to hold up and you'll actually be able to sell. So we kind of wanted to have long-term financing in place. So because
Yeah.
we know we'll hold on to the property, it's a great piece of property. So if it doesn't work out, if the number's not right, we are not
Yeah.
forced to sell. Whereas if we do a short term, then we are kind of on the hook. We have to
Yeah.
so we wanted to keep the options open. So the other option is to also refinance our investors out of the property,
Yeah.
and get their capital back and then maybe hold on to the property.
Yeah.
That's also on the table. That's not off the table. So
Yeah.
I think having long-term and such low interest debt allows us to kind of go multiple ways. We don't
Yeah.
have to follow a certain exit plan.
Right.
So I think that's important for us.
Yeah, that makes sense. So going with the longer debt just made it so it gives you more options as far as how you want to exit the property.
Yeah. So we could refinance, give our investors infinite returns, keep them in the deal.
Yeah.
Most investors would be pretty happy with their capital return and
Oh yeah.
infinite returns on their investments. So
Right,
yeah.
right, right. Absolutely. Yeah, that's a win for sure. Okay, cool. All right, so let's go ahead and segue to the last segment of the show, the lightning round. Got 5 questions for you.
Okay.
Ready?
All right. Shoot.
What's the best?
Unprepared, but ready.
Yeah, for sure. All right, so what's the best advice you've been given?
Don't try to do it all. Figure out what you're good at. The same thing I spoke about. I think that was a brilliant piece of advice. Figure out your value add, figure out your niche. What are you good at? Leverage it.
Yeah. Good. What's the best book you've ever read?
Ah, that's a hard one. I like so many books, but I think I will pick The Alchemist. It's a book by Paulo Coelho. He's a Brazilian author, and it's been translated in gazillion languages. I don't even know how many.
Yeah.
The reason I like that book so much, the first time I read it, I didn't honestly get much out of it. I just thought, oh, this is a fable, whatever. I didn't really read into between the lines. The second time I read it, I think I've read it at least 6 times now. And every time I get in there, I find a nugget that changes my perspective.
Yeah.
And to summarize for the listeners, it's about how the shepherd goes in search of his destiny. And he goes to Egypt, and you just have to read it. And the idea is to trust in yourself, to follow your intuition and follow your heart,
Yeah.
and trust that everything will work out for the best.
Right.
Don't second guess yourself. I mean, there will be doubts. Everyone has doubts, but just follow your intuition and heart. They know a lot more than you do.
Yeah.
And when you really want something, and that's like the core idea of the book, if you really, really want something, don't give up on it, because the universe is going to make it happen for you.
Right.
And I really, really, truly believe that in my heart. And I
Yeah.
think that book has changed my perspective about the things I want in my life and how I'm going to pursue it.
Yeah. Yeah. That's an awesome book. I'm gonna definitely check that. I've heard about it before. Haven't read
Yeah.
it yet, but I plan on reading that book for sure this year. Okay. What are some rituals you have right now that's making you a better investor?
Yeah. So I think for me, waking up in the morning and doing this morning routine has changed my life. So I joined this Miracle Morning Accountability Group.
Yeah.
So we the book is called Miracle Morning by Hal Elrod.
Mm-hmm.
And the idea is that, I mean, you don't need a book to tell you that, but that helps. You know, it kind of gives you a foundation. The idea is that
Yeah.
you wake up every morning and follow the same routine.
Right.
And I wasn't a routine person. I would just do things whenever and whatever.
Yeah.
So I think having that morning routine's been calming. It's really helped ground myself a lot. So you start with meditation, affirmations, visualizations, exercise, reading, and journaling. Scribing is what he calls it. The routine is savers, SAVERS, savers. So I started doing that about, has it been 112 days today?
Yeah.
I've been tracking it every day.
Wow.
So, and I wanted to get to the point of like making it a habit, because, you know, they say if you do something long enough, like I
Yeah.
think they say that 60 days or 90 days, it
Yeah.
becomes a habit. And I think I've finally gotten to the point of making it a habit. I wake up in the morning and I want to go sit in my corner and meditate. That's the first
Yeah.
thing on my mind. So,
Yeah.
so I think having that routine really helps ground your day and make you more productive the rest of the time.
Right.
And also those affirmations have been life-changing,
Yeah.
because sometimes you stop believing in yourself or you doubt yourself, and it just
Yeah.
snaps you right out every morning.
Right.
You're
Right.
just like,
Right.
no, I'm putting all this away, regardless of how I wake up when I feel,
Yeah.
or
Yeah.
how I feel when I wake up. I change my mood, and it brightens up my day. So it's really been helpful for me.
Yeah, that's awesome. That's awesome. What is one thing you're doing right now to help you improve your business?
Oh, I'm doing a lot of things. So let me think about what is the most, I hope is going to be the most impactful. Um, so right now I'm doing a couple of things. I started doing webinars last year that was super impactful. I think for 2019, my answer would be doing the webinars, connecting with people, expanding and creating a brand.
Yeah.
That was the focus for 2019 for me, because I came out of nowhere at the gate, and, you know, I wanted to establish a brand.
Right.
So I focused a lot on giving to my investors and educating people with absolutely no expectation of how it's going to go.
Yeah.
So that really helped me establish my brand. And I want to continue doing that. That's for sure something which has been impactful for me. For this year, I think I want to focus on building multiple streams of income for myself.
Yeah.
In terms of a business, I am doing apartments. That was my mainstay, but I started exploring these other asset classes, because I feel like from an investor perspective and for my business, there will be better opportunities.
Yeah.
Like in hotels, I could make a 20% IRR. In apartments, I can't do that anymore.
Yeah.
So exploring and opening up the business to other asset classes, I think will be a big mainstay for this year.
Yeah. Gotcha.
And I want to
Gotcha.
start also working with more people and hopefully expanding my own team
Yeah.
to get more people with different asset class experience. I love like senior assisted living, but I don't know anything about it. And honestly, I don't have the time to do it.
Yeah.
But I would love to have a partner who might explore that.
Right.
So, yeah.
Right.
So
that makes sense. That makes a lot of sense. Back to the team building. It'll always go back
yes,
to it.
absolutely. I mean, you can do it all. That's just the bottom line, right? Like you
Yeah.
have one person, figure out what are your strengths and what you can do, and
Yeah.
find people who have opposite or complementary strengths. And I really feel like I'm getting to the point where I need another person on my team. So
Yeah.
hopefully I'll find the person. So
Sounds good. All right. Last question for you. If you can give your younger self one tip in regards to investing, what would that be?
get to commercials sooner. Yeah, I think if I had started multifamily like when I did start, or at least I was exposed to it, I
Right.
think you have to, a lot of investors I still talk to always think single family homes. They want
Mm-hmm.
control. Like I want to have
Yeah.
entire control of the deal. I'm
Right.
like, control is not important. Where do you make money is more important.
Yeah. Yeah.
So
Absolutely.
understand the difference. Like sometimes you can give up control and have less hassle and make more money. Would you
Yeah.
rather have that than control a deal?
Right.
So
Right.
find your
Good stuff.
sweet spot.
Good stuff. Well, really appreciate you coming on the show today. Tell my listeners, how can they get in touch with you?
Oh, sure. Multiple ways, but my website is probably a good starting point. I have Cherry Street Investments. So that's all spelled out, Cherry Street, entirely spelled out, investments.com. I also have a Facebook group called Purely Passive Investor Group. Where I educate my passive investors. I do a lot of webinars, so I highly encourage you to join my webinars. And I have some amazing webinars lined up for this year. I have a mobile home park expert, Frank Rolfe, coming on my webinar. I have a underwriting deep dive with Omar Khan, who is amazing and
Yeah.
who knows his stuff like
Right.
really
Right.
well.
Right.
So I have a lot of I have an attorney coming on, Mauricio Rauld, and he's going
Mm-hmm.
to talk about investor documents and what are you looking for when you look at these legal documents as an investor.
Yeah.
So just a lot of amazing speakers lined up for this quarter, and my next quarter is also getting full right now. So if you want to speak at one of my webinars, I would love to have you.
Yeah.
If you want to bring a specific topic to me, that would be amazing. But if you want to really, you're a passive investor or you're a person just getting started, then feel free to look up my webinars. It's on my website, cherrystreetinvestments.com. Love to see you on one of the webinars. It's a great way to get started without leaving the comfort of your home. So
Yeah.
yeah.
Good. Well, we appreciate you coming on the show today, and let's stay in touch.
Thanks, Will. It was great talking to you.
You as well.
Bye.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.